Welcome back to the channel, everyone. I'm Skylar James, and today we're going to be talking about how you can choose to never work another day in your life. How? The answer is dividends. The end result for many long-term investors to accumulate such a robust portfolio that its dividends can replace or even exceed your current income. That's when you can retire regardless of your age. Want to find out how? I have 4 enticing dividend strategies for risk appetites of all levels. I'll show you 2 long-term tactics and 2 short-term tactics, and teach you the most important lesson to winning short-term dividend trades. A dividend is usually cash paid to shareholders because the company or fund has excess profits. A dividend isn't legally required to be cash. In theory, Shell's dividend could be a gallon of gasoline for every share held, but they're usually paid in cash. Dividends are more than a payment. They are psychological for many investors. If a company raises their dividend, investors are generally happy about it. A reduction in a dividend is not taken very well. A dividend reduction reflects a changing financial condition for the company, usually a negative one. They have less money to give away to shareholders for some reason. Take these Ford and Shell headlines. You don't have to be a financial whiz to figure out how each of these companies' financials looked when they made these announcements. So I promised you 4 strategies for profiting from dividends, and here they are. For the long haul, history says investing in high dividend payers is a way to beat the market. Take a look at these big picture charts. Whether you start in the 1920s or the 1970s, you could have beaten the market if your portfolios always purchased dividend big shots. Even since 2005, dividend growing companies outperformed the S&P 500. If you're looking at the last 3 years, the S&P has ticked slightly higher than the dividend growers. Check out the performance of the Vanguard Dividend Appreciation ETF versus the S&P 500. VIG versus VOO, virtually neck and neck. That's short term. I tend to value long-term trends more. Every niche of the market or sector of the market takes a breath once in a while. That's what's happening here. So long-term strategy number 1, buy companies with high dividends or companies that grow their dividends annually and with conviction because they outperform and it's proven. Long-term dividend strategy number 2, own big dividend payers during retirement and live off the income they provide. Imagine having $1 million portfolio of dividend big shots that pays you 4% yield. That's $40,000 a year going right into your pocket without having to liquidate any holdings. The year after that, another $40,000, then another, and another, and another. Having a nest egg of, say, $2.5 million at the age of 70 sounds like a lot of money to young people. I get it, but it isn't that hard to get there if you make smart, recurring investments during your working years. A 4% dividend on that 2.5 million would yield you 100 grand in cash every year without selling any positions. Could you live off 100 grand a year? These 2 long-term dividend strategies are proven and respected. Money managers get paid to recommend these to clients all the time. You should know about them too. Now you do. Big shot dividend payers can both beat the market and provide steady income during retirement. Short-term dividend strategies, however, are a bit more fluid and risky, but there are 2 interesting tactics worth looking at. One tactic is options-based, one is stock-based. Let's look at the rules of the game first, then we'll get into playing to win. The most important rule of short-term dividend poaching is managing the ex-dividend date, or the X date for short. This is pre-announced calendar date by company or fund, and the only people who receive a dividend are the shareholders as of the day before the X date. So if the X date is Friday, April 2nd, the only people who get the dividend are holders as of the end of Thursday, April 1st. Does that make sense? The payday is completely different from the X date, and the payday comes even later. It could be days or weeks later. You don't have to own the shares on payday to get paid the dividend. You only have to own the shares at the close of business on the trading day before the X date. Does that make sense? So short-term dividend strategy number 1, buy the stock the day before the X date and sell your entire position on the X date. This is called the dividend capture. You'll get your earned dividend on payday, same as people who have held the stock for 10 years, but you only held it for 1 day. Sounds great, right? But does it really work? Some of the time. Think about all the things that have to line up for this to be a profitable trade. First, when a company hands out a dividend, at the very fundamental level, the company is transferring cash from the balance sheet to you, the shareholder. Shouldn't that reduced cash be reflected in the share price? Yes. If markets were perfectly efficient, then yes, absolutely. The company is now worth less. Just like if I had $1,000 less in my bank account because I paid a landscaping guy, I'm now worth $1,000 less. Dividend payouts are the same. Think of this example. If Apple is paying $1 per share in dividends on Tuesday, we should expect the share price to drop $1 between the close of Monday and Tuesday's open. The company is literally worth less, tens of millions of dollars less sometimes for these large cap stocks. In the short term, you as a trader are taking a huge gamble buying the stock, knowing the company is about to be worth less fundamentally. There's a tangible reason why the stock price should fall. But markets aren't perfectly efficient, and we all know fundamentals aren't always reflected in a share price. So for this imaginary Apple example, let's say the share price only drops 50 cents instead of $1. Maybe there was good news about iPhones that morning, so the shares didn't fall a whole dollar to reflect the dividend. That's great. You, as a trader, would be net positive 50 cents per share in that case. You sell, you walk away with your profits, and I applaud you. Take the opposite of that argument though. What if there's bad news about Apple during the 16 hours of holding the stock? What if the bad news drops the share price $3? Even with the $1 dividend going into my pocket, I'm now negative $2 for every share I'm holding. Do I sell at a loss? Do I marry this stock and wait for a reversal? How low does it go before I cut my losses and bail? And if my financial plan is to bounce from stock to stock, owning any holding just long enough to qualify for dividends, I can't do that if my funds are all tied up in Apple, waiting for the share price to trace higher. That could take days or even weeks. So this is real world risk, and to me, outweighs the reward of this strategy. It's too much of a gamble for me specifically. But if you live on the edge and short-term strat number 1 piqued your interest, you're gonna love short-term dividend strategy number 2. Follow the same dividend capture logic as strategy 1, but amplify it using options. Puts specifically. Choose puts if you think the share price will drop due to the weakening of the company's balance sheet. Remember, their balance sheet weakens as they move cash to shareholders when the dividend is paid. This trade requires trust in the efficiency of the market to work in your favor. Trust that fundamentals matter, and then profit from the anticipated drop in price. Did I say trust? No, this is a little bit of a gamble and a pragmatic choice to believe that the markets are efficient. The same pitfalls lie ahead of you in either these short-term dividend capture strategies, but with options, a small move in the stock price is actually a big move in the options price. Since options have an expiration date, there is a clock ticking on this one. All of this to avoid buying and holding for the long term reminds me of when Jeff Bezos asked Warren Buffett, why don't people follow your investment strategy of buying and holding the S&P 500? Buffett responded to Bezos, because nobody wants to get rich slow. I'm an advocate for getting rich slow, but if you have a large appetite for risk, one of these technical tricks might be a great fit for you. But understand that they are risky and they don't always work out. If they did, everyone would be doing them. There wouldn't be buy and hold investors. We would just show up with our money on X date Eve. That's actually a word I just made up. And we would sell the next day. This seems like a great time to remind everyone that I am not a financial advisor and this is purely for entertainment purposes. To focus on getting rich slow, look at those long-term dividend strategies, buy and hold ETFs like VIG and Noble, funds that only include companies with consistent dividend increases. You saw the charts? History shows it's been a viable way to beat the market in the past. So regardless of your risk appetite, there are dividend investing strategies for anyone. I hope you picked up some tricks for your investing quiver to help you nail your retirement bullseye. And if you enjoyed today's video, please gently tap that like button and leave a comment down below. Thank you for joining, and I'll see you on the next one.